Welcome, everyone. First thing I'd like to say is members of the committee or anybody else who has a question, if you make sure you would please speak into the microphone, because we're obviously broadcasting this on our YouTube channel, and some of our members are participating through Zoom. And if you don't speak into the microphone, they will not be able to hear us. I want to welcome you to a joint meeting with Senate Insurance Committee and the House Insurance Committee. I want to welcome Senator McClendon, Vice Chairman of the Senate Committee, and Chairman Zuber in the House, and Vice Chairman Ford from the House as well. We have an issue before us today. We're going to speak of two issues today. One is about our wind pool, and the other one is about insurance coverage for children for hearing deficiencies, for hearing aids. The first item is one that's I've dealt with is 2 years as a chairman, and kind of inherited it because before Hank or I, either one, was named chairman of this committee, our previous chairman under our last administration extended a repealer on the non-admitted policy fee, or sunset, for lack of a better term. And it will the 3% non-admitted policy fee on insurance provisions that goes to the wind pool will expire in July if nothing is done with it. So that's what we're here to meet about today. I want to say after Hurricane Katrina that we had people that were brilliant that saved the insurance industry in Mississippi. We had insurance companies that were basically saying, we're going to leave the state of Mississippi. Our losses are too great. And we had non-admitted carriers who also took great losses. And the first person who's going to speak to us today was at that table, along with Senator Kirby, who was chairing the insurance committee at the time. And they basically saved our insurance industry by coming up with some changes to the wind pool. And the two major changes at the time after Hurricane Katrina, the losses were so great, we had companies threatening to never write any more insurance in Mississippi. So the insurance commissioner, it was Commissioner Cheney's predecessor, welcome Commissioner Cheney, had the authority to assess the local companies, the admitted carriers, our domestic companies. The non-admitted companies, it was agreed that they would pay a 3% fee on policies written in all 82 counties on non-admitted policies through surplus lines. And that's the part that we're discussing today, the 3% fee. Last year it amounted to around 18 to $19 million. And first speaker is going to be Tom Quaka. Tom is a personal friend of mine. I've known him for many, many years. He's been in insurance business for over 50 years, very successful person in the insurance industry, recently retired from FCCI Insurance Company, and now is in independent consultant. And the name of your company now is, I know him as Tom Quaka, but he's got a fancy company name, Southern Insurance Consulting. And as I mentioned, Tom was at the table when these changes were made to the admitted and non-admitted policies carriers in Mississippi after Hurricane Katrina. So what Tom is going to do is give us a overview of basically, we're sitting at that table in 2007 on how we talked the insurance companies into staying in Mississippi. And he's going to give an overview of the basically zeroing in on this 3% fee so that we can be educated on it and ask questions about whether we want to extend the repealer or not. Thank you, Tom.
Thank you, Mr. Chairman of both House and Senate, Mr. Vice Chairs of both House and Senate. It's my pleasure, and members, excuse me. It's my pleasure to be here today. You know, I've decided that I'm perfectly fit for this historical job, since I think maybe I was the only one here in 1968 when Camille hit. You know, the reality of it is that what we're looking at today is nothing more than a product of the evolutionary process of both government, politics, insurance, financing, and economic development. And perhaps the latter term in this case is the most important, being the economic development and the continuance of the success of the Mississippi Gulf Coast. The reality of it is, if we're going to talk about where we are today, it's only important that we go back in time and talk about 1969. You know, I had the great fortune to get in the insurance business, mostly by accident, in 1968. And in 1969, when Camille hit, I was sent down to the Gulf Coast. You know, I had been at work for less than a year, but sent down to the Gulf Coast to review the landscape there. And quite frankly, and I've seen hurricanes and tornadoes ever since, I've never seen anything that dramatic in my life. You know, I still have Polaroid camera photos of that event with ocean-going vessels sitting in the middle of Highway 90. That event was, it's important to know that that event was a windstorm event. It was not a water or wave wash event. Those ships were blown up on those streets. They weren't washed up on those streets, different from Katrina. At that time, there was no pool. There was no sharing. And if you had insurance, you were in good shape, because we had never expected to have that kind of event in the state of Mississippi. You have to think for a second. If you go back in the 68 and 69, and you thought about Mississippi and wind, you didn't realize that Mississippi, the analogy being like a bowling alley, we don't get spares, we get strikes. Camille was a strike, came all the way to the Jackson and did damage at the reservoir, millions of dollars worth of damage in the Jackson Reservoir, 180 miles or 190 miles away from the Mississippi Gulf Coast. Never happened to us before. 110, 120 mile an hour sustained winds. They were 85 miles an hour in Jackson. I remember trees being blown down in Jackson and canopies being blown off the drive-through convenience store service stations here in Jackson. That event was an awakening that leads us to today. But there's a lot that transpired in between those two events, today and then. At that point, it was decided that there needed to be an involuntary mechanism called a pool. You know that we have assigned risk pools for automobile drivers who can't get insurance. You know, we have assigned risk pools for workers' compensation for employers who cannot get insurance. Well, we decided, the industry and our legislature decided that let's come up now with a pool for these individuals who cannot voluntarily buy insurance. And how do you finance a pool? Well, you go to all the insurance companies and say, okay, you're an admitted carrier. I want you to remember that word admitted for a second. The admitted makes you a solid citizen, where perhaps non-admitted could make you a solid non-citizen, okay? So a solid citizen, the USF&Gs of the world, the New Hampshire insurance companies of the world, the Travelers insurance companies of the world said, okay, let's form a pool, a residual pool. And let's sell them the entire package. And we sold them a dwelling policy at that point, not just wind. We gave them fire and we gave them theft. We gave them the whole thing. That was sponsored by an insurance company. The board of directors was made up of insurance company executives. And what happened every year is that we took in premium. And if we had more premium than we had losses, then we gave it back to the insurance companies. If we had more losses than we had premium, we assessed the insurance companies. This was known as the Mississippi Insurance Underwriting Association, MIUA. MIUA at that point functioned very well, until there was a little evolution that came along with insurance companies getting out of the personal lines business. Because of reinsurance issues and companies withdrawing from the markets and consolidations. So in 1987, the Mississippi legislature adopted statutes creating the MIUA. Statutes were repealed. The Mississippi State Rating Bureau at that point came on and took over the servicing, if you will, of what the insurance companies had done previously. Got my tense wrong there. So they formed their own pool. At that point, it was still divided among the insurance companies because the insurance companies were still running the organization as the board of directors. Well, over time, And through the evolution of some legislation and some politics along the way, it became more of a agency, consumer, and company combined organization. What I want to say is that the original wind pool operated 18 years without really a hiccup. You know, we just didn't have a lot of problems. It was run more like an insurance company because it was run then by insurance company managers, executive officers, and it was written on, much of it written on insurance company paper at that time. And it was annually split up based on either loss or profit, like every other assigned risk. If you go by workers' compensation today, in the assigned risk, what that pool does is every year they separate profit from loss. And if there's a loss in the workers' compensation pool, then there's an assessment against the carriers. And if there's profit, then there's a distribution made to the carriers. I want to go to now up to Katrina. Katrina was not the wind event that Camille was. Katrina was a water-driven wind event. The surge on the Mississippi Gulf Coast was one that hadn't been seen before. I don't think that actuarially it could have been known that we could have had that kind of surge. Now, remember one thing about Katrina. Katrina was a water and wind event. Camille was a wind event, two separate types of catastrophes. The water event, by many's judgment, was about 40% of the loss. The wind event was about 60% of the loss. Well, think for a second, if your roof blows off and your house is gutted by a wave and you're a consumer, what do you think it is if you don't have flood insurance? You know, the real key and what made that storm so significant, what made it so expensive, what made it so controversial was the water. And the fact that the guy with no roof and his house gutted by water only had wind insurance. He didn't have flood insurance. Well, what has changed today? The fact is that for a mortgage, for insurance, you have to have flood insurance. So what we're looking at today is not going to be a Katrina, and it's not going to be a Camille, perhaps, but it could come closer to a Camille than it would a Katrina going forward. What is important here is I want to tell you a story about what happened to a real live insurance company in Mississippi on that very day. At that time, I was president of Briarfield Insurance Company. You know, so this is a thing where I have skin in the game, a lot of skin in the game. I was president of Briarfield Insurance Company. And I've got to tell you, Briarfield Insurance Company was a domestic insurance company. Do you know what that means? I answer all my own questions, so you don't have to. Okay. What it means is that this was a chartered, regulated insurance company in Mississippi. It was formed here in Mississippi. It was financed here in Mississippi, and it was regulated here in Mississippi every 3 years, a financial audit. And I've got to tell you that during the time of Briarfield Insurance Company, which was over a 10-year period, the company was very successful. We went through several audits and never had a single criticism. We employed 100 people. For that, I am proud. Briarfield Insurance Company on this very day had $30 million in surplus. It didn't have $350 million in surplus. It had $30 million in surplus. When that storm hit that day, we lost $7 million on that day. And keep in mind that Briarfield Insurance Company did not write personal lines. It did not write personal lines on the Mississippi Gulf Coast. So all of our losses came from Jones County and the Hattiesburg area. Laurel and Hattiesburg were where all of our losses came from. But on that same day, we not only incurred the $7 million direct loss. Now, keep in mind, we have $30 million premium. We're writing, $30 million surplus. We're writing about $50 million in premium. We also had a $7 million assessment. So little old Briarfield Insurance Company with $30 million surplus just lost $14 million. Now, why is that important? It's important to make the reinsurance point. It's important to make the reinsurance point. Had we not had the right kind of reinsurance, we could not have succeeded. We would not have lived on to fight and win another day. By the way, within a few years, we got all of that loss back because we were able to, because of the pricing conditions at that time, because we were here and so many people were not. Right? We filled that aftermath void. The point I want to make here about reinsurance, reinsurance takes away the gambling. What is gambling? Well, gambling is mean you can either win or lose big. That's not a business venture. That's gambling. The Mississippi Gulf Coast, if you were to write insurance there without reinsurance, it would be gambling because you got to win big or you got to lose big. What happens with everybody is this, sharing the risk. You know, Mississippi is going to write 40 or 50 or 60 miles worth of beachfront and go 100 miles inland at the most, right? That's a microcosm in the insurance world. There's no spread of risk. There's no such thing as an actuarially sound rate for that microcosm. For the rate that we charge for wind, there's no such thing as an actuarially sound rate. That's a gambling number. We either win big or lose big all the time, no in between, right? So reinsurance takes that away, gives us that law of large numbers, gives us those numbers of average and that spread of risk, which is so important to all of us in financing exposures. That's what insurance companies do. They finance exposures. They don't gamble. We can't gamble. I want you to understand the difference between that little bitty area that can take a total shock versus from Texas to Florida, throwing our numbers in with those people on that coastline, all the circumference of the Gulf, and coming up with average numbers that we require. Take away the surprises, take away the gambling, maintain your surplus and your ability to fight on. Talk about not admitted fees. Remember I talked to you about the fact that you have a citizen and a non-citizen. You know, we actually call not admitted carriers alien carriers. Why? They're not licensed in the state of Mississippi. Now, that's not bad. There's a reason for all those people, but for just the moment and for our purposes, let's think of them as being the odd man out. Let's think of them being the non-citizen. Let me tell you what a citizen does. Let me tell you what a Briarfield does, a Travelers does, a Hartford does. They allow you to use them to maintain the economy. You come to us, admitted carriers, and you say, look, we've got to set up this pool, whether it's wind, whether it's automobile, whether it's workers' compensation, whether it's medical malpractice, that we had a very successful event with, whether it's medical malpractice, we want you to share in this losses. These people can't get insurance. We have to fill the void for the economy, for the state, for the good of the citizenry. We have to fill that void. Well, let's all go together here, you admitted carriers, and let's set aside a little money. And let's put this pool together. Let's put this assigned risk together. And what we'll do is we'll share in the losses for these people who can't get it anyplace else, and our economy continues. That's what your admitted carriers do. That's what Briarfield did. That's what Travelers does. That's what FCCI does. Those are admitted carriers. They are citizens of your community. They are paying you, and they're paying people to work for them who pay taxes here in the state of Mississippi. They're not foreign. They're not located in San Francisco, where their office is that they just phone in. Like a not admitted non-citizen might do. And so what we said to this admitted group, we said, okay, you carriers, we're going to form a windstorm pool. And what we want you to do is maintain the solvency of that pool. Well, I want to go back just a second, if I can, and talk about the day after Katrina hit. The day after Katrina hit, there were a lot of insurance people concerned. There was a lot of people in this house concerned. There were consumers who didn't quite understand what was about to happen. And what was about to happen to the Mississippi Gulf Coast was something short of annihilation, because there wasn't any way anybody was going to get any insurance on the Mississippi Gulf Coast after what Katrina did. Katrina, water, no flood, aggressive plaintiff litigation, to the extent that if you're sitting around in New York City or Bloomington, Illinois, and you're looking at Mississippi as having 0.6% of the insurance market, you're going to say, why do I want to put up? Why do I want to invest? Why do I want to put in the case of Travelers, why do my stockholders want to invest in the Mississippi Gulf Coast? So we had that to deal with. Then we had the fact that we had to actually do the right thing for the citizenry. You know, we had to keep the Gulf Coast going and thereby keeping the Mississippi economy going. So it was the insurance companies and you, that got together and created the current windstorm program that we have today. And what that program did, it did this. An insurance company, as I've used the term gambling before, an insurance company, when I took that $7 million loss, I had no top end. It could have been $700 million loss, you know, not $7 million, or it could have been 70. There was no top end. So if there's no top end to your investment, a loss, that's gambling, isn't it? So you can't measure your exposure. Golly, I'm sorry, y'all. My hands are just all over the place. You can't measure your exposure if you don't know what your minimum exposure is or your maximum exposure. There was no top. So the very best thing we did with this legislation, or you folks did with this legislation, is put in a maximum that an insurance company would have to pay. If I know that it's only going to subject 10% of my surplus to loss to be given back to the state because of a catastrophe, then I'm okay. I know how to handle it. I can manage that. That's a manageable outcome. If it were 100 plus or 1,000 plus percentage, then that's not manageable. You know, just that unknown. Insurance companies can insure anything. They can insure anything, absolutely anything, if they know what the exposure is and they know what the limit is. So it's a finite business. We put finite back into it. Well, by doing that, we were able to encourage the insurance companies to tippy-toe back in ever so slowly. Because of all of that pending litigation that was going on, nobody really knew how that outcome would be. So with the fact that we now put a cap on the top end of that, we now are able to provide insurance. That was the one and only thing the insurance companies wanted, to get back into the state and start writing more actively. Remember that under the current legislation, that you have cash, you have reinsurance, and when you run out of that reinsurance, you may have some surplus, but if you don't have that, then what happens? Here come the insurance companies, and you assess them for whatever is needed beyond that. And up to extent, and then above that, you buy bonds, and the insurance companies are obligated to buy the bonds. Now, that's very elementary, but the point I'm going to say is that the windstorm pool is not going to go bankrupt. You know, there's a whole lot more money available there. There's a whole lot more security available there than can be used in certainly my lifetime. And I know, depending on the health of Commissioner Cheney in his lifetime. So we're not going to run out of money. And that should never be a consideration with the way this mechanism works. A little bit about the fees now. I just told you that if indeed we have a giant loss, then at some point the insurance companies can come in and be assessed. That's the good news for y'all. Here's the bad news for the consumer, is that the insurance companies can then assess and recoup that money over a certain limit from everybody in the state of Mississippi. Now, you talk about your biggest nightmare, my biggest nightmare, our collective biggest nightmare is we start billing Aunt Martha in Hernando, Mississippi on her beauty shop. And we're charging her an extra 10% of her premium. You know, those are the things that we collectively want to avoid, but those are the safeguard mechanisms that are there to protect not only the pool and the insurance companies. Now, because of that, it was decided that the non-admitted market, you know, the non-citizen, the guy who's not voluntarily helping with the state of Mississippi or its needs, that individual, that company should have to pay something as well. And because we decided that at one point we're going to assess the entire state of Mississippi for the losses on the Gulf Coast, we decided that we would come up with a fee for them. Now, that fee has bounced around from time to time. It was a percentage of property only, then it was a percentage of the entire premium. Now it's a different percentage of the entire premium, and actually it's 3%, which represents about $16 million income annually to the windstorm pool. $16 million. Is a handsome amount of money over an amount of time. It was done to help create a surplus. If you went back far enough, you'd find that, you know, reinsurance at one time was darn close to $50 million cost. You know, there wasn't much margin for any profit after you paid $50 million for reinsurance. Well, as time went on and the situation grew differently, and there was really better management of risk all these many years, that has come down considerably to less than now $20 million. $20 million when you have a surplus of $350 million is certainly a manageable number going forward. So anyway, so we decided to do that because we knew the insurance companies had the possibility of being assessed, and then the constituents, the citizenry, the population of the state, all the other insurers would wind up paying as well. Now that assessment on Aunt Martha and Hernando wasn't just on her property, it was on her automobile, it was on the homeowners, it was on all the property casualty lines with the exception of workers' compensation. So it could be a considerable amount of money. It has been done in other states such as Louisiana. Louisiana, of course, is not the poster child for anything we wouldn't want to do. The monies that have been created out of the excess surplus lines not admitted fees have all gone to the windstorm code. Now, over a period of time, there was legislation that redirected some of those funds. In 18, there was $1.5 million for capital maintenance fund. That pretty much went undefined. 18, there was 4.5 million for the rural fire trucks. In 19, there was 3.5 for rural fire trucks and supplemental fire trucks fund. Remember that or you may not know this, but the Mississippi Surplus Lines Association, which manages all the non-admitted carriers, has also contributed to the fire truck fund of $6.5 million. 1.5 of that went to the state, and 5 million went to the Department of Insurance. So there has been methods and manners of reoccurring income to help support the fire truck fund. The current financial condition of MWUA, Mississippi Windstorm Underwriting Association, 3.53 million. And some of my numbers could be coming from the last financial audit or from the last annual period. However, Joe Schumacher did give me a few updated numbers today. But nonetheless, is that the assets there are $353 million, and the defined surplus is $316 million, which obviously means that they're holding back some of the reserve, which of course they should. Total reinsurance, and here is, you may have a blank on your page, depending on, at the top of page 3, depending on what printing you got. Reinsurance coverage right now is $450 million. There's a $75 million retention, so that means that the top end is $525 million. All right, understand? I got the math now. You've got $450 million of reinsurance sitting on top of $75 million of the surplus. The reinsurance premium is $19,500,000, which, quite frankly, if you look back in time, you could see where it was in a $40 million range based on the TIV and the time. The reinsurance market has been reasonably stable over the last several years, but who knows, based on wildfires and tornadoes and other events throughout our hemisphere, what will happen to it. It can go between 5 and 7% one way or the other in common times. In unusual times, it can go much higher. There are 13,301 insureds today, down from almost 50,000 some years ago. There's 2.34 billion right now in TIV. So what we have is around $500 million and some surplus to protect a total possible of 2.3 billion in loss. If those numbers sound odd or in any way discombobulated to you, they shouldn't, because there's no way you can have a total loss of your TIV. It mathematically is impossible because of spread of risk, circumstances, etc. You know, your normal exposure, if they were compacted and it were one whale of a storm, might be 35 to 40% of the exposed value. Now, nobody goes to the bank with these numbers, but they're historical numbers, and that's all we can deal with going forward. At one time, the board, when it started after Camille, the board was made up exclusively insurance companies and insurance executives, because it was really run then like an insurance company. Well, the events following that, and then Katrina changed all of that, where it became more of a pool that retained its earnings, retained its surplus. It didn't distribute it. Okay, that's the basic difference between what we do now and what we did 25 years ago. We distributed the funds 25 years ago. We retain those funds today, right? That's how we got, well, so we got surplus, because we were able to, number one, collect the money, number two, make an underwriting profit, and number three, we were able to invest the money, and it's invested this as though it were an insurance company. It has an investment policy that is no different from any other insurance company. And over the last 5 or 6 or 7 years, I know the earnings have been well over $50 million in those investment accounts. So that is added to the surplus. Keep in mind that when we started, we wound up having about $140 million. We've grown it to 350. You know, there's no shame in that. That money, that original seed money, however, you have to know was state money and federal money. So those monies now, as you can understand, are now commingled with these $350 million of surplus that we have today. Majority board back then was insurance companies. In 2007, it was changed. The board was changed to be more representative of the community, in that it had insurance company people, it had agents on it, and then it had a couple of consumers. Now that's a pretty diverse group. And quite frankly, it would be something like perhaps a caucus where there was a lot of conversation and progress sometimes was hard to come by. Possible things that you could do going forward. And I wouldn't really ask to work on this or even talk about it, but I'm just going to take a moment and say that there's just so much potential and so many different things that can be done. And the only thing that we can do wrong is do the same thing we did before. You know, we need to be, as everybody needs to be today, a little bit more progressive in some of the opportunities and be a little bit more open-minded. You know, the WNPO needs to have, and I believe has something of, a depopulation plan. That's really required by statute. So, you know, what would be progressive is, let's put, to put something in writing that you thought that you could actually attain. You know, a perpetual windstorm is not for the best of everybody. Will there be a windstorm forever? Yeah, because there's always going to be, Aunt Martha and her juke joint who aren't going to be able to get the windstorm that she may want to have. By contrast, Louisiana and Texas do have some forms of depopulation plans and mitigation. I've used the term mitigation before, and it's met with just some kind of awful responses in a few cases. It seems like it's a dirty word. Well, it's a dirty word because of MEMA. If you recall, MEMA got a block grant for mitigation, and some of the money just was used differently than it was intended. Some of it, quite frankly, may have just absolutely evaporated from the earth. So if you think about mitigation, especially in the legislature, a lot of you folks think about the MEMA event in mitigation. That's not at all what could be proposed, what could be successful, and what could be considered. Mr. Chairman, with that.
Thank you very much for a great summary. Tom has agreed to stay around to answer any questions a little bit later after we hear from all our presenters, because you may prefer to ask a question to him or our other presenters. Thank you so much, Tom, for the time you put into making sure that we had carriers in Mississippi, and for your knowledge today. I appreciate that. We'll turn it over to Chairman Zuber, who's going to introduce our next two speakers.
Thank you, Mr. Chairman. Members of the committee, ladies and gentlemen in the audience. Most of you know our next speaker as the chairman of the board for the Mississippi Wind Pool. However, I have a personal connection with him. I know him as a constituent. I know him as a friend. I know him as somebody that is extremely well respected in and out of the insurance industry in the state of Mississippi. He is somebody that understands and realizes that he has been tremendously blessed in this life. And he never fails to give back to his hometown, the city of Ocean Springs, and the state of Mississippi. It's my pleasure to introduce the Honorable Scott Lemon.
Y'all have all these inserts in the packet that Janet provided to you. You want to follow along.
Scott, will Joe be supplementing your presentation? You want me to go ahead and introduce him
Yes.
too? Okay. Along with Scott, we have Joe. He is Joe Shoemaker. He's the manager of the Mississippi Ratings Bureau. Y'all have the podium.
Thank you, Hank. Thank you so much for the kind words. I am from Ocean Springs, as Hank mentioned. I'm a Gulf Coast insurance agent. We have 3 locations on the Gulf Coast. I was 5 years old when Camille hit, and I can remember that night quite well, as Tom shared with us earlier. I'm honored to be here. I'm currently serving as chairperson of the Wind Pool Board, serving at the pleasure of the governor, a position I've held for the last 3 years. I think I'm getting close. Joe Shoemaker has been with this organization for over 40 years. So when we want to talk about the history of the Rating Bureau, and we want to talk about the history of the wind pool, the progress or the great progress we've made over the years, in light of Katrina, in light of the small events we have, has been quite remarkable. And we owe a lot of that progress to Joe's commitment to this organization. I did want to start us off with before we get too deep in the presentation. I am one of 8 insurance professionals that sit on this board. Ginger Gorman is with Farm Bureau. She's in the audience today, just supporting us. She said she's been on the board for several years now, and we really appreciate the perspective she brings from Farm Bureau companies. So thank you, Ginger. When I look at and Tom was a recent board member. When I look at these 8 insurance executives, we've got over 200 years of experience in the industry as a whole. So when we sit down and have these meetings, we go from local insurance independent agents to corporate executives that are with national carriers. So there's quite a different perspective there. And I'm going to tell you, on my 8 years on the board, we've had 2 votes that were not consensus votes. And I think that goes to the amount of discussions and commitment we have to our plan on moving forward. And I think it goes to the commitment that Joe and his staff are there to help us. I do want to thank the commissioner for being here and all the support that we get from the Department of Insurance. This is, there's a lot of moving parts here. We're going to look at some numbers that show that a lot of our properties are more than half of them were built prior to Katrina. And the reason that we do not have the newer homes in our plan is because the commissioner does an incredible job of recruiting new carriers to Mississippi and making sure that these carriers are writing business on the coast. And that's huge for us as we look at the size of this plan. So thank you, Commissioner, and to the department. We're going to talk a little bit about risk transfer. I think Tom labeled it as gambling. We've spent, if you look at some of the financials, we've spent over $700 million since Katrina buying reinsurance. $700 million. It's a lot of money. But we purchased over $10 billion worth of coverage. And that was to provide that risk transfer mechanism to make sure that we kept from our carriers stable and provided a stable market. We also have 98% of the exposure in this pool is residential. and more than 75% of that is below I-10. And Joe has a great slide to show of that as well. So Joe's controlling this, so he can speak wherever he wants to.
Thank you, Scott. And let me just say that, you know, I am 42 years into this career, and it's been a great pleasure to serve in a lot of different functions as a manager of the Rating Bureau, which I'll talk about for a few minutes, a little bit in a few moments, but to serve with a great board, actually 3 separate boards. Scott is chair of one of them, as well as members, and, you know, to serve with people that do it because it's a public service. I mean, none of them get paid a dime for what they do. They may get reimbursed a little bit of expenses, but they don't make a dime. So it's humbling to serve such people who are really out for the betterment of the state of Mississippi. And in my times that I've been down here, I compliment you all as well. We're not alone in this. I want to just throw this first slide and all this stuff. And I think Scott and I have talked, and we're going to be jumping through a lot of this because Tom has covered a lot of this already. So we're going to be jumping through it, but you have the material there for you and your reference. We're not in this alone. There's 33 states that have at least one residual pool. You can see the numbers over on the right side. I also made this presentation the last time I was here before this committee. Some of those numbers have changed a little bit. You'll see the red ones mean those that have increased in size. The blue ones mean those that have decreased in size. Now, just out of curiosity, I did run some numbers. Florida, since the last year, which was last time I gave this presentation, which was in 2019, Florida has gone up by 22%. North Carolina Fair Plan has gone up by 5%. Those are the 2 red numbers you see there. The blue numbers all have gone down, but for the most part, most of them are very similar to us. They're going down relatively gradually. I will proudly say this: Mississippi, among all those states, has gone down more than any of the others. Mississippi, those numbers reflect an 18.4% reduction from the numbers I gave you the last time. That's on the only closest state to that is South Carolina at 15. Louisiana went down 4.4, and Texas went down 1.5. I am serve on the board of directors for the PIPSA, which is Property Insurance Plan Service Organization, also past chair. We all get together and we can see these trends go around. We know that depopulation in those states that haven't experienced a major storm continues. It is slowing. At some point, you kind of get to only the residue that's left. And that's sort of what we are as a residual plan. States that experience storms. My counterpart in North Carolina had $1.7 billion of reserve. $1 billion of reserves. Florence comes through, does 1.7 billion of damage to North Carolina. So storms and experience are all of it. I don't know what I did to do that.
In closing.
Get backwards. I guess I think we've talked a lot, but I do want to cover real quick, and Senator Kirby and I are close with this one, and you've heard mention about the Rating Bureau. And let me just share with you, the Rating Bureau is an organization that was formed in 1924, Senate Bill 26. We're an insurance support organization. We do a lot of many different functions throughout the state. One of which is we do property inspections, and I'll leave this for your reference, but we do property inspections. We did over 4,000 last year. We review fire sprinkler plans for cities and for new sprinkler properties. We also work with ISO and other actuarials to come up with commercial fire and dwelling rates that we file on behalf of companies, as well as forms, et cetera, rules and loss costs. One of the things that's closest to me, as I spent 18 years doing, is going around grading communities on their fire protection capabilities. We now have 792 fire districts or cities graded around the state, which saves a lot of premium dollars throughout the state. We do all of this. We work with city planners. We test new fire trucks. We do all these things, and we don't, not for a single dollar or local or state funds. These are all, our operation is funded by the insurance carriers, the admitted carriers that you've heard so much about. Those admitted carriers that are licensed are the ones that pay for this. And we do it at no cost. And we run and manage these two pools at a cost, on an at-cost basis themselves. We've done it ever since their inception from MIUA. It was the old MIUA when I first started, and the Bureau was administering that all the way up into present, which has been through several storms, hurricanes, as well as named storms. So with that being said, I just wanted to give you some overview of who we are. There is a lot of advantage to having organizations where we can pull from each other, because we have to scale up and down. Some of the charts that you see about the wind pool, we started out at 18,000 policies, or 16,000 policies, excuse me, at the time of Katrina. We go all the way to the almost 50,000 that Tom spoke of. Now we're back down to the 3,000. So there's a lot of swelling and contracting, depending on what the market does. And that's good, because that's what we want. We want the market. We want to be there only to fill the void, and we want to get out of the way and let the market return when we can. And that's been done and been one of the greatest depopulation plans because of what our commissioner has done, what the legislature has done, what our boards have done at getting out of the way and letting private enterprise take its course. So with that, we swell and we contract. And there's advantages to being in an organization that we can move and shift and do things around and share that cost. So with that being said, we can move on, Scott, to a little bit of the wind pool itself.
Yeah, I think Tom covered most of this history in his recap. You know, our from a board's perspective, you know, we want to make sure we have long-term stability in the marketplace, and you'll see some trends. Joe talked about the number of policies we manage. Right now, we're in a very tough reinsurance market with the wildfires, with the social inflation that Florida has with all their litigation. We're in a little bit tougher market than we had been in previous years. For those of y'all that remember some of these pictures, I think the only beauty in these pictures is you can't smell them, because it sure stunk down there for a long time in our post-Katrina days and the devastation we had. I think this is one of the most telling slides of where we came from, and Tom touched on some of these topics earlier. The number of policies that we had in force, claims. We had $1.8 billion of exposure when Katrina hit. $1.8 billion of exposure. We had $720 million of losses in Katrina. So 40%. Tom told you it was mathematically impossible to lose your full 1.8 billion, but 40% of our book of business was paid out in damages. At that point in time, we had $12 million of gross premium. It's pretty simple math that we had 60 years of premium spent on Katrina losses. 60 years of premium and losses there. At the time, we had purchased $175 million of reinsurance to cover that $720 million loss. The 250-year probable maximum loss is an industry modeled metric that we use when forecasting the amount of return periods to purchase insurance to. Most insurance companies purchase in the neighborhood of 100 to 150 years of probable loss, but because we have such a small shoreline, we purchase more, and in years since we purchased much higher than that as well. Tom was pretty clear on the $545 million that were assessed to the carriers, and the non-admitted carriers were not assessed at this point in time.
Just real quickly on this one, this is sort of a little bit there for reference as far as how that mechanism, I mean, there was a $545 million piece of pie, and all of the admitted carriers had to pay their share. And then how does that get divided up? And in some cases, it gets divided up based on how much volume they had written statewide, but it also gave them credit for writing business on the coast. A carrier that went down and voluntarily wrote business on the coast was able to write themselves out of some of their share of this assessment. Therefore, but you still had, the pie still so big. So someone else has to take that load. For every piece, a dollar that gets written out, someone else that didn't write had to take on perhaps an extra more than their share would be from a statewide basis. And that was no different. It was very sound mechanism. There was, as Tom pointed out previously, there was no cap to that. We assessed them $545 million, but it could have been a higher number. Whatever we needed, we could go to them and get, and they had to pay their assessment. Now, it may have left a bad taste. We certainly saw that it did, because some of them were ready to exit the market after Katrina. Some of their assessments from us was greater than their statewide written premium. Some of them were saying, well, I didn't write any coastal exposure. Why am I having to pay coastal exposure? Because you wrote in the state of Mississippi. So we saw times that companies were reassessing whether or not they wish to stay in the state of Mississippi or not. If I wrote a policy in Tupelo or in Oxford or in Starkville or South Haven or wherever, then that went against my statewide writings, and I may have increased my share of the piece of the pie. So we needed stability. Stability was very much needed in the market. And what the legislature did and the industry did and the commissioners did was to stabilize that. And you've heard a lot about stabilization, but it was getting some of that burden off. This is just a slide that talks through that process. There were a lot of things that happened. There was a lot of disputes. You don't have a storm the size of Katrina without someone being upset. So there was a lot of disputes, not only among claimants, but this was an unprecedented sharing of a $545 million pie, so to speak. And some didn't disagree with how big their slice was. And we went to court. The board faced lawsuits, and this went on for quite some time concerning the entire assessment process and the dividing of the pie. Anything else, Scott? You want
This is one of my favorite slides. You know, I think that you heard Tom say earlier today, or that Mississippi is 0.6% of the national insurance market. We're less than 1% of the national insurance market. So, you know, there's carriers that can just walk away from Mississippi and write 3 neighborhoods in Dallas, Texas. I mean, that's the truth. We're that small. And it took me quite some time to come to that, and a little bit of the humble pie. But when we talk about long-term stability, we've got to be able to have that marketplace that our commissioner works with these new carriers with, to bring them into Mississippi, validate that they're qualified to write here, and provide a great marketplace. One of the interesting things is we go on our reinsurance buys and talk to the underwriters across Bermuda and London. Is those underwriters are so in tune to what's going on in this state from a legislative and a regulatory standpoint to make sure that we're not like Florida or California or New York. And the work that this group does to keep Mississippi stable is a huge factor in how we're able to transact business with these folks.
This is just a couple of 3 reasons that some of them were eager to maybe get out of town when the opportunity arose. But everyone knew that something had to be done post-Katrina, right? You all knew it. I think everyone in our area knew it. The insurance industry knew it, and certainly the board knew it. And so with that respect, we were not only dealing with the growth, but how do we get rid of growth? And one of my greatest, funnest things to do is to have a telemarketer call me and start talking about how they have a plan for me to grow my business. And I said, I'm not interested. Well, everyone wants to grow your business. I'm not interested. Matter of fact, I'm trying to get rid of the customers I have. Do you have a plan for that? And typically they hang up pretty quick, but that was the goal. How can we get out of the way? How can we let the market return we don't want to be competitive. How do we be non-competitive when it comes to clients over risk? All these things have been reviewed. We go down through, we took over 300% growth. Right after Katrina in 2006, we were getting 300 new apps a day. So I had to staff up a lot. And then how do we get rid of them? So you start creating geographical rating tiers. You make sure everyone's paying a geographical, it's non-competitive price. We have built some reserves. We update coverage for it, but we don't want to be too competitive. We offer only wind and hail. What we've seen around the country, some of those other plans that may have been a full homeowners policy have now gone to offering only wind and hail. But that's where the void is. We want to fill the void that exists, and that's it. So you run into problems when you start providing too broad of a coverage, but we want to be there for the citizens of the coast. I've always said, it's not that we don't want you. We want you to have somebody better than we do. And if you have to be with us, we're going to try to provide you the best service that we can. But if you're with us, you deserve the best service and what it covers. Not that we don't want you, we just want something better for you. And we hope we get out of the way and have it there. Some of the things that have happened, we have increased, there's now a 2, 5, 10, 15, and 20% deductible for those who might want to take on more of that risk themselves and get their premiums down, then that's certainly there. 2% is our base. As Tom and others have said, Katrina was a lot of water. We now require flood insurance in those high hazard zones in order before we will write your wind insurance. Now that comes with a lot of different problems that we could probably have a whole another session on when it comes to flood and what's going on with flood and et cetera, but flood is a requirement. Mitigation discounts, we offer some of the heaviest mitigation discounts for a home. I had a reporter call right after we did this, and this was about Fortify for Safer Living. It's IBHS. They are the standard on mitigation and building stronger homes. Well, how many fortified homes do you have? I said, well, I don't think I have any. Well, it's not working. Your program's not working very well, is it? I said, it's working great. They're not with us. Mm-hmm. So if for those homes that can strengthen and do better, make themselves better, they typically can find another market. One of the things we did just a little over a year ago is we incorporated a fortified roof endorsement. For every policy that we write now on a replacement cost coverage basis, we will pay up to $2,000 at the time of loss for them to improve and strengthen their home to a fortified roof. Not only do we pay them $2,000 extra on their claim to strengthen their roof, once they get it, they get premium discounts. If they stay with us, they may very well be able to find another market once they get those certificates. So BKEGS, which is building code enforcement, we do that. But just a few of the things you can see at that bottom bullet point, since some of these things have gone and been implemented, we've seen over 70% reduction in our policies in force. I think that's a very successful depopulation to go from 46,000 down to 13,300. I'll be honest with you, if you'd asked me 3 or 4 years ago, would we ever get back below Katrina status? I'd have said, I doubt it. But we're below Katrina status as far as policies in force. Now our limits are still higher, but prices are a little different than they were in 2005.
Yeah, I just, as Joe talks about some of these bullet points and they're just bullet points on this screen. But truth is, some of these were very painful to implement. A lot of work with the Department of Insurance. Some of these ideas even came through the Department of Insurance to help us formulate them and make them reality. And it all drives to that 70% number at the bottom.
Real quickly here, I think we've touched on these numbers about where we were, where we went, where we are. So they're there for you all to see. Here, I'll just skip through some of these charts very much. You can kind of see the curve of where we started, pre-Katrina, where we went, where we've been, and where we are. That's on limits. This is policy counts. Moving on, Scott's already mentioned that we're 98% residential. We're 98% residential. We're in Harrison and Jackson County. That's where we are. We're also 77% below the interstate in Harrison and Jackson County, in all three of those counties. Just a little bit of depiction. I remember, this is just a couple of maps to just kind of give you an idea about where these risks are, what type of risks they are. They're dwellings, 98% dwellings. They're primarily in Jackson and Harrison counties. That's our two biggest counties. They're 77% below the interstate. They're along the beach. To Tom's point earlier, it's okay if we get missed, and we have been very fortunate that we've gotten missed in the last years. Like I said, we haven't always been so lucky. I would say we won't always be as lucky as we are now. Our neighbors on both sides of us have been hit. And when we get hit, as Tom so very well put it, it's a strike. Not much of a glancing blow. We normally get hit with everything. It's just a matter of how strong was the hit. And that's come to place. But just a little bit of an idea. Sometimes, you know, pictures are worth 1,000 words to me. I can a little bit depicts on where our risks are. Also, we can say, well, we've got, the coast is different. The coast has been rebuilt. It's greater. It is, but this little statistic right here shows you who we have. And this is 71% of the dwellings that we have were built prior to Katrina. All that means is the market is working. We are depopulating, but we get what's left. You know, some of the last ones to leave. Scott, you want to?
Yeah, this is a little chart that just shows the our reserves that we built up over the years on the bottom, and then the top is our limits of reinsurance purchased. I mentioned earlier that we'd spent $700 million, or a little over $700 million to buy reinsurance, but we've also purchased $10 billion in limits over those years as a risk transfer mechanism.
The only other thing I would point out, Scott, is that you can see as our exposure has gone down, the purchase has gone down. You know, so I think that would be expected. Our retention, as we have funds, we are able to take on some of that risk ourselves. You see that as far as the history goes. This is the chart that really shows the funding. It shows the three sources of funding that we received since Katrina. The first, the one on the far left there you see was federal grants. Right after Katrina, and there's a couple of slides on down, but you'll see that we filed for a rate increase. As a matter of fact, we filed for a 398% rate increase. Needless to say, that made it downtown, and that was Commissioner Dale. And it's a little, you know, you can't possibly think about giving someone a 398% rate increase right after the worst storm that's hit mainland. But there was funds that were received. Those funds were given us as sort of a counterbalance to some of the rate increase that was needed. At the time of Katrina, we had purchased that $175 million worth of reinsurance, cost us $8 million. $12 million was our total annual premium. The year after, I needed $35 million to buy reinsurance. Didn't have $35 million. So we go get a line of credit. So you can see the need immediately grew because we were populating so fast right after Katrina. Companies were so scared that they were going to get hit with another big assessment. So that fear factor, until all the things that were done got the market settled down, it was a tremendous need right there. We needed funds. I didn't have money to buy reinsurance, and we needed reinsurance to keep the market stable. So the state, you all, that the gray part there was a state reinsurance assistance fund. That's what you all gave us, the $20 million a year for like 5 years, I think total. It was 4 years total. So that, excuse me, 5 years total. And that was there to help us offset the cost of reinsurance. As a matter of fact, I remember, you know, I was kind of a new at my position out there at the time. You know, at the time, millions used to scare me. And then I realized that, you know, it's just a lot of zeros. And I got way too comfortable signing checks with a lot of zeros on. But at the same time, these funds, when we would buy reinsurance, I would submit those invoices to the department and to, I think maybe some of it came through MDA, I believe. And then we would get reimbursed for it. So these funds were set aside to offset the cost of reinsurance. And of course, the blue, as you all see, have taken the course of the non-admitted fees that we're talking about. And here's the chart for the history. If you look at where that's been, we've talked about, Tom explained kind of where that's come from, when it started, how it's changed a few times along its course, and where it landed just last year in 2020.
This is a rate history. You can see at the beginning of this, other direction. Yeah, you can see at our rate history, we've really had pretty stable rates for so many years going across there. And then recently, as the marketplace has changed on the coast, we took rate in the two below I-10, the two zones below I-10. There's a carrier that writes about $300 million worth of exposure on the coast that's leaving multiple states. We felt like that we needed to take a rate adjustment just to hedge off any of that business coming into the pool. Let's see, there's, I guess, a few more slides on things that Tom covered.
I think most of those are, we've talked about some legislation that's happened for 1500, and then we talked about HB 444. But it really all goes down, and I would like to skip forward to where we are today. And where we are today is, this is a flow chart of, as he said, we have funding. We don't run the risk of insolvency. We will be able to pay the claims for those policyholders that have purchased coverage from us. So there is a process. I think this is a clearer picture of exactly the funding tower and how we will be funded. If you look here, the one on the left, currently we retain the first $25 million worth of losses. We pay that out of our funds. Then the 2021, we purchased $25 million layer worth of reinsurance. Okay. And then for 2020, that was purchased as well, which I'll share with you. If you haven't forgotten, we had Hurricane Zeta last year that got into $32 million worth of loss, of which we will collect about $7 million out of that 25 layer down the bottom. But here, it's a mixture of funds that we have on hand, insurance that we have purchased. As you can see, the 25, and then we exhaust at 525 million. We have run out of our insurance, and we've contributed 75 million ourselves, and we've run out of reinsurance. Then we have about $178 million left. That's less the reserves that we would need to carry forward for the next year. We have about $178 million left to put toward losses. At that point, we would move into an assessment process. That would be at about the $700 million mark. We would assess the admitted carriers up to 6% of our last year's TIV. Currently, that's $144 million for this year. Now that's not recoverable. They would pay that. That would be the same as the 545 that they paid during Katrina, but it's now capped for a single event at 6% or $144 million. Now, if we had multiple events, that moves to 250, but for a single event, that's 144. Now, the important line that I'd like to point out is, once we have spent our funds, once we've spent our reinsurance that we purchased, once we've assessed the carriers, the capped amount that we can get from them, you get into the red. The red is the part where every, as Tom talked about earlier, every P&C policy, auto and home policy throughout the entire state gets assessed to pay back some bonds that we probably will have to purchase when we get into the red. Right now, that's at the $847 million mark. That's about 35% of our total amount. We've talked about percentage. That's about the 35% amount. That line you see right above that is Katrina. Right now, based on our current 2.35, 940 is about where the 40% mark is. To me, that's the one that settles down. We have a method of funding. It's just a matter of where it comes from or which sources it comes from. Okay.
Well, one of the things that we talk about in the insurance business, and it doesn't matter what line of coverage it is, whether it's auto, work comp, property, is frequency and severity. And this is an illustration of severity. If we have another event similar to Katrina, this is what it's going to look like. It's severity. But what we've seen over the last couple of years is a frequency issue with the number of storms. Heck, we're almost at the Greek alphabet already this year. And that last year was unprecedented. So our concern, because we do take a lot of cover down at the bottom, is two major event or minor events could start getting into our reserves as a severity, as a frequency issue as well.
Real quickly, this is Zeta. Just to remember, we have missed most of we've missed the major storm since Katrina. Last year, we thought we had made it. I don't ever remember one coming in October the 28th, that late in the year. We were into the Greek alphabet when we got Zeta. Zeta generated almost 4,700 claims. Fortunately, they weren't real severe claims, but we will incur about $32 million worth of losses from Zeta. And of that, we incur, just like that tower showed a minute ago, we take the first 25, and then the remaining part of Zeta will be on our reinsurers. Questions, but I think we had, you have one more slide that really, I think maybe added to your packet. I think Senator Michelle, you had mentioned about the reinsurance tower, but if there's any questions about that, it's basically covered on that 25 of the towers immediately before.
I do want to ask a question. You mentioned about how active a season we had last year, and we'd gotten into the Greek alphabet, and Hurricane Zeta did significant damage in Mississippi, and the effect on the plan was about 32 million in loss. And of course, that's something that the plan can easily cover. What we're worried about is another Katrina or Camille. Joe, you had said you thought you could maybe model Hurricane Ida that hit Louisiana maybe before the session starts. Could you get us information on what would have occurred if Ida had gone 50 miles to the east and hit Mississippi instead of Louisiana?
It's only speculation at this point. We have asked the modelers and they're working on it now. I checked with them just the end of last week. And a lot of the footprint from Ida hasn't all been captured, the data, understanding to run. And one thing I told them, I said, I don't want speculation. I want sound numbers. So we can only speculate now what Ida would have done at 175 and 180 mile per hour's wind had it been 50 or 60 miles further to the east. I can tell you as it was approaching, we were concerned about it. We were real concerned about it. And while I don't wish my friends in Louisiana any bad luck, but I'd rather not have a place to fish over in some of the areas that it hit, rather than it have been 50 or 60 miles to the east. It could have been a different situation. I do have my counterparts from what I understand in Louisiana. Louisiana has a plan. You've seen it on the charts. They did go down about 4.4% last year. Their reinsurance, best I understand, they retained the first 35. They purchased up to 545 million. Above that, all indications are they may go right out the top of it. Now that's just speculation. I don't have anything to back it up. But from what I'm hearing, there's some expectation that they will blow through their reinsurance cover of 545 with Ida. And I just can't help but believe it would have been a lot worse had you moved it to the east and get it up in the bay. That's just my own speculation.
Okay, members of the committee, now's a great opportunity to get your questions answered. We held a hearing on this last year. We're having a hearing on this, and when we get to the session, there's not going to be a whole lot of reason to discuss it much more because we've really discussed this subject a lot and had several bills that have died or gone past one chamber and failed in another, vice versa. So please ask your questions now. Anybody have a question? Senator Kirby has a comment.
Thank you, Mr. Chairman. I just wanted to cover a few things really quickly that you guys said that should have gotten all of our attention. And one thing that really caught my attention, and I'd heard this before, that after Katrina, it would take the insurance companies, based on their losses, it would take them 60 years to get their money back in premiums. 60 years is a long time. And then one thing that you didn't say is that after Katrina, we actually did have a domestic carrier go bankrupt. And then what I'm trying to say, I guess, is that we need to make the point, and you said it, and the cartoon showed it, that insurance companies do not have to be here. They're private companies. They can do whatever they want. We've had several companies that pulled out after Katrina. Some never came back, some did. Thanks to our commissioner, we've gotten several new companies, and I appreciate that. And then the last thing is that our wind pool bill actually became a model act for these other states. And I appreciate you guys working so hard on that. That's it.
Dr. Boyd?
First of all, I want to thank y'all so much for what you do, and and I think I know some answers to some of these questions, but I kind of want to make sure that I do. And so I'm going to answer some questions. I'm going to ask some questions on the comparative income statement. Do y'all have it in front of you? I've just got a couple of clarifying questions that I have on this. If y'all can help me out answering.
Joe has, we have one.
You
Thank you.
got it? Okay.
Yeah.
All right. Just some terms. I want to make sure that I think I know the answer to this, but I'm not sure. So on the comparative income statement under revenue, you have under that third line, the phrase change in unearned premiums. Can y'all tell me just briefly what that means?
Yes, ma'am. It's insurance accounting, and I'm not an expert in insurance accounting, but insurance is different than most accounting. It's easy to count how much inventory I may have. You may know if you are a retail grocer or a retail supplier, how much stock and inventory you have. Well, insurance is a totally different thing because you have it, but you haven't earned it all yet. So what happens is as you go through the periods, you see some change, whether policies are leaving or they've been canceled. There's some change. You're estimating how much you've earned and how much you haven't earned. And that's what that column is for.
Okay, great. Thank you. I wasn't familiar with that. Another thing on that comparative income statement, I see that we're spending less as we go through the years here. We go back up to the reinsurance, which is right up above it. I see that we're spending less through the years on that. And I think I may know why, but can y'all explain that to me?
There's two large factors there. Number one is the limits that we purchased. And then with the reinsurance cycle, pricing cycle, you may have to pay more per gallon to purchase those limits. So it's a combination of pricing per gallon to take it to gas terms, and its amount of limits that we purchased. I think we had one slide in there that showed our limits purchased.
Right.
It's coming down. Yes, ma'am.
Okay, so let me ask you that on the limits purchase, and you may have said this and it may have, I may have not heard it right. So is there a amount that y'all are trying to target? Like, are you trying to do 50% of the property? Are you trying to do, is there a policy limit that y'all have with the board or anything like that in there?
We do have a reinsurance purchasing model or plan that we go through the exercise every year to say, hey, are we striking these items as we make the decision? When we start looking at what to purchase, there's times that we'll look at upwards of 15 or 20 different options. Just to look at how much we want to retain on the bottom, how high we want to go on the top, what's the combination. So we look at a bunch of different items, pricing models when we do that. But we do have a reinsurance purchasing plan that we follow through.
That's like board policy that
Yes,
y'all,
ma'am.
okay. All right. And then I think I saw in the slide, y'all purchased like the reinsurance purchase for like 20 or 21 was like 21. Was that right? 21 roughly in there. Was that right?
$1 million?
Yes.
Yes, ma'am.
Okay. All right. Thank you.
Yes, ma'am.
How much does that buy? 21 million in reinsurance?
Well, this past year was about 19.5 million for 2021. That bought us 450 million. That's about 4.3% overall rate on life is what that purchased.
Okay.
And I might add, some of these cases, as you see, I've kind of used the example sometimes, it's like a budget of buying groceries. you spend a certain amount of your budget for groceries. And then you try to go out and buy many groceries as you can for the money that you want to spend on groceries. And sometimes if they're cheap, you can buy more. Sometimes if they're not, you have to cut back and buy different types. You may not be able to buy steak all the time.
Well, I will ask a question to expound on that right there. If you were to double the amount of reinsurance that you bought, obviously the cost would go down because it's the top layer that the reinsurers are responsible for after the other losses are met. If you wanted to double that amount, what do you think the premium would be? If you went from 450 and we want to make sure we're in great shape for another Katrina and you bought 800 million in coverage.
So it's a great question. I think you've got the rate online on that top layer.
Yeah,
But
probably
one,
around 2.
but one of the conversations we've had as a board over the last couple of years in protecting this reserve and the financial plan or our investment policy is we were making more on returns for that reserve money we have than we could buy reinsurance at the top. So it from a risk transfer standpoint, it made more sense to keep our reserves protected and buy cover on the top, although it may seem like you're buying too much, but we were protecting the top end of our reserve fund.
Senator, I know that 25 million X of 25, that first 25 million layer that you saw was the most expensive layer. And that cost us about $2.5 million, a little over $2.5 million. Now, it was a good buy last year that we will collect about $7 million from it. Now, take that out, move up high, it does get relatively cheap. But there again, it depends on market conditions. There's a certain amount of money people expect on as a return on their fund money. And if they're going to put their money at risk, then you at least want some minimum return. So there's some minimum rates, even when you get high, it doesn't get down to zero. They're not going to give it to you.
Any rule of thumb you could give us?
On the top end?
Yeah, top end probably.
Isn't that rate on it?
You spent 21 million on reinsurance, but you've got 26 million in premiums coming in and around 7 million in interest earnings on investments. So if you spent all that, 26, 32 million instead of 21, would that prevent us from ever having to worry about another Hurricane Katrina?
It would certainly be something that we want to put we could price and check. I really depends on, I can't give you a price on what those layers would cost up there, but I can only speculate it probably would be around a 2% rate. So I'm just guessing. It could be less, could be more, but it depends on the market. So that would be about what you're looking at for every.
And we have, to complicate it a little more, we have some participants on our $25 million layer at the bottom that want to participate up top just because they want to spread their risk. So, we kind of are getting the deal here and getting some throw-ins up top. And that changes every year with market conditions. I mean, it gets kind of sophisticated.
Senator Delano, you have a question?
Thank you, Mr. Chairman. Again, I said this in our hearing that we had during the session, people of the Gulf Coast, many of us have had to rely on wind pool policies over the years. And I know that I've worked publicly and privately with your staff, Joe, and y'all have done an incredible amount of work. And I know that the board has been very studious in trying to do everything they can to help the market conditions and to bring back the private sector so that you can depopulate your plan. So I want to tell you, thank you very much. And my people appreciate that. I do have a couple of questions that's related to some of the topics that were discussed today, especially some of the things that Tom talked about. Tom spoke about total insured value and how that is the total amount of money or total amount of property that is insured by the plan. However, whenever you're trying to predict what your probable maximum loss will be, we know that it's not going to be 100%. And I think he used the number of 40% as kind of a market number. Katrina, we had 720 million in losses to the plan, correct? Okay, and that equated to that 40% number of the total insured value at the time. Is that correct? Of 1.8 billion?
That is correct, yes.
Okay, so today we have 2.35 billion in TIV. And what is our PML that we are using to make our justifications for reinsurance purposes?
This year we bought two. Where's your reinsurance fund?
Hmm.
Mine's over there.
It's not-
Well, so let me ask you this. So 40, let me ask it a different way. 40% of 2.35 is right close to $1 billion. Is that correct?
940 million. Yes.
Okay, so 940 million, which is also illustrated on this chart, correct? It's
Correct.
within, it's in the middle of that area in red that we're showing, correct? And what we learned from Katrina was that we did not want, or that we had a very unnecessary or unfortunate occurrence where I think, as Tom said, it was the nightmare for every politician, which was we had to go out and assess every single person that had insurance policies in the state of Mississippi, an amount that was not claimed. If I'm looking at this chart that you're showing here for your catastrophe funding chart with 940 million being in the middle of this red, aren't we setting ourselves up? If we had another Katrina event, God forbid, but wouldn't we set ourselves up for another nightmare scenario? And the dollar amount that we're looking at above our reinsurance plan is very minimal with respect. I think it's a delta. Well, it's a change from 940 million to 847. So was it 120, 160 million difference? Why would we not? What is driving our decisions to determine what our PML is going to be to determine how much reinsurance that we need?
So that's part of that lengthy reinsurance purchase process that we go through. This year, I believe we're somewhere in the neighborhood of the 400-year PML. And it goes back to what Joe shared earlier. We typically spend between 80 and 85% of our premium, our income, to buy reinsurance.
So in other words, instead of using a 250-year storm event, you've changed it to a 400-year storm event so that it will help you back into the number that you need.
That's correct. And,
Okay.
and we purchased higher than 400 years when the market allowed for it.
Okay, and the result of that puts us into that red area, right? Because if we were basing it off of a 250-year PML, that would require us to purchase more reinsurance that would get us out of the unlimited assessment to the statewide policyholders, correct?
I don't, you said if we bought to a 250 year, that would bring us down. We're purchasing way above the 250 now. So if we purchase just to the 250, then that would be coming down.
Okay.
We bring that red chart down.
All right, thanks for correcting me on that. And again, I think what I've learned the most about how you purchase reinsurance and how you make those financial decisions on how to purchase that reinsurance is pretty well illustrated in this particular chart. And I don't think that many people in Mississippi understand the layers the layers and the different types of policies and the decisions you have to make on how you distribute your cash across those layers affect the overall wealth of the plan or the financial stability of the plan. Can you help us understand how you use that 21 million, or where that $21 million are actually, I think the best way of saying it is, how would you use the state's, or excuse me, the wind pool plans revenue to space out across the total cash liabilities within this total boundment of $520 million?
I think he's asking. How did we come to this?
So that would be not only your reinsurance cost, but also the copay or the co-insurance
Correct.
and the deductibles that you use, and the fact that in some of these plans, it's for a single storm event. And what would happen if you end up with multiple storms in a year, or in events that where we had, say, 2 Zetas that would come through? And how would that be treated by the wind pool plan?
I guess let me say that, I mean, this is all predictive. I mean, gosh, if anyone could share with us when, how big, how many the next storms would be, we would certainly be able to make a much wiser, more efficient decision, but none of us know that. And just like we're trying to protect against the next major 40%, Katrina 2, that's one thing that goes through the mind. We need to protect higher. We need more. We need to keep out of that red. But at the same time, you can get in that red based upon multiple storms. Gosh, we saw all the storms. I mean, if you looked at the maps from last year and how many storms repeatedly hit the Gulf Coast last year, and our neighbors just to the west, how many did they get hit by? So not only do you have to think about one big severe storm, the next Katrina 2, but what happens for multiple medium-sized events? So it's really, it is a gamble, but you don't know where to place your chips always, and know where you might get the best.
Scott, I want to, you're looking at the reinsurance program. I think I saw Scott had it. We looked at over 20 different options for this. We looked at some that took us straight up to $100 million deductible. First $100 million was on us. If you look at the light blue on here, that's what we call free and unlimited. If we have 8 occurrences, that's going to pay out every time. If you look at that dark blue up there, that's true reinsurance, which is a single event. Plus you see the RPP, which means we can buy a second event cover. If you look at the very top, that top and drop, if we have a first event that goes to $125 million, that top and drop will come down and fill in that 50 to 100. So it's we look at a bunch of different options. It goes to a board that has over 200 years of experience in the industry and the chance to talk through all these different options that you may have. So Tom, I think
I'm sorry, I may be able to put your mind at ease somewhat, Senator. You refer to the red zone, which is a great term, but there really isn't a red zone because the insurance companies are going to drop down and fill that void. The insurance companies aren't going to pass that cost on till several $100 million on top of that. So without a doubt, today, hands down, there's well over $1 billion worth of insurance out there.
Well, I think that me and my coastal delegation colleagues will tell you that we get accused every single session of requiring the state of Mississippi to subsidize insurance rates on the coast. And I just wanted to clarify that this board has done an extremely good job to make sure that the premiums that are collected and the revenues that they have received go into a place to protect all of Mississippi from the events that we saw after Katrina, where you had to have those assessments. And going back to this plan, Scott, I believe, and I know Joe will remember, there were not too many years ago where we were not able to get free and unlimited plans in these lower tiers of reinsurance. And we had to spend quite a bit of our cash, or at least retain quite a bit of our cash in that plan to cover those unfortunate events. So thank you for doing a very good job and continuing to do a job to protect all Mississippians from having an increase in their insurance cost or cost for living here in Mississippi. You've done a great job and I appreciate it. Thank you, Mr. Chairman.
Mr. Chairman, I have 2 things. I would be remiss if I did not remind everybody that it is the 40th birthday of Senator Delano today. So happy birthday. And then secondly, Joe and Scott, the commissioner has done a great job in bringing in new companies. And I think that was mentioned by somebody before. For the benefit of the committee, describe how is the private sector for wind coverage on the coast south of I-10?
Well, I live it every day. We've had about 3 years ago, the Lloyd's of London market, which wrote a great deal of coverage on the coast, started exiting the marketplace. And if it weren't for the new carriers that the commissioner has recruited in, and even additional capacity from some of the carriers that are already here, it could have been really a brutal situation. I mentioned earlier AIG, which is a national carrier, is closing down some regional business that they're doing, which is going to affect us. I think that's the next ticking time bomb. As far as maybe seeing, can the carriers that have been brought into the state cover the ones that are just getting out of the business? And that's to no fault of our own. It's just a business cycle. So the marketplace is healthy. Prices are pushing up. That's happening all across the sector. We saw the surplus lines last year was about $17 million, just under 17 million. That's by and large the hardening marketplace on the coast, or the surplus lines carriers that write the municipalities, the large at risk, having increases in their premium and having increases in their taxes. So I'm confident that we'll continue to, with the help of the department, recruiting good carriers, and they'd love to do business with Mississippi. When we talk to new carriers in our shop, we ask them how they're working with the Mississippi Department of Insurance has worked with them, and it's always they're always pleased with how quick they can get in business, how quick they can vet their information and turn them into the world of writing business. So thank you.
Thank you.
Senator McClellan.
Thank you, Mr. Chairman, and thank you for all those that are speaking. I've got just a couple of questions on the income statement. How often do you guys put out to bid for reinsurance? Do they come to you? Do y'all go to them? How many reinsurance companies are there?
So we do it's annual. It's our renewal date is St. Patrick's Day, March 17th. And the data set that Joe prepares to send to the reinsurance market is usually an October 31st date is what our data set usually finishes up. But we redo it every single year. We have the conversation. We've got some carriers that have been on our program for over 20 years. There's mergers and acquisitions, there's new capacity coming in, and that's where we're able to kind of play it against each other.
When
Just to add to that, we start in October each year. That's kind of when we do our snapshot of where we are, what we have. And that begins the computer modeling process where they model our exposure and see how much it's grown, how much it's changed. And as Scott says, we have a broker that goes to the market for us and on behalf of us. And we have probably some 40 to 50 carriers that are actually on the program in some area throughout the tower.
Okay. When you said y'all have a broker that does this for you, would that be where I see on here there's salaries involved? How many people do y'all have employed?
Those salaries are my staff. As I said, it swells and it contracts depending on the size. We're down now to probably a little less than 20, but those salaries are our salaries. And that is on a cost basis. We're allocated, separated from the Bureau. For instance, even my salary is cut 3 different ways. And we have other duties and functions that we have that we're able to share with the other 2 organizations. Other 2 organizations, one being the Rating Bureau, the other being the other residual pool that we have, the Mississippi Residential Property Pool.
Okay.
But those salaries are my staff salaries.
But there's no salaries for the board members.
Say it again.
No salaries for board members.
Gotcha. How about under the administrative and expenses? Because I was looking the salaries. Salaries for 2021, you've got 1,813. And then under administrative and operating, 2,609. But that line has been extremely larger than that over the years. And I was just,
Oh, he's looking at the trend.
the administrative and operating line. We've got it anywhere from 4 million, 3 million. And now we're at 2.
Yes, sir. I can tell you in 2010, that 4.3 million, we bought a new software system, policy management system. It cost us in the neighborhood of about $2 to $3 million.
Okay.
Otherwise, you're seeing the administrative and operating is all other costs, salaries are broken out of that.
So in essence, the State Rating Bureau, does the Mississippi Wind Pool run its own operation, or does the State Rating Bureau have a hand in that?
But the rating bureau by contract is operating and administrating the wind pool. Yes. And all of the expenses are allocated out, every expense, postage, sharing of office space, personnel, benefit, everything gets allocated out separately so that it's only on a cost basis. All three entities are nonprofit, so there's no profit to be made by any of them. It's simply a cost on a cost basis.
So when there is a profit, where does it go?
I beg your pardon?
When there is a profit, where does it go?
There it isn't. As far as the wind pool goes, the wind pool it stays in the reserve or the surplus, which has been able to accumulate since 2007. If there's any, that's where you see the net gains in that organization. It's able to stay there. Previous years, pre 1500, it would have been distributed back to the carriers.
Okay. Are you comfortable how the wind pool runs now? Could it be under another agency or under the, say, Commissioner of Insurance?
I think it's very efficient. I mean, because we're able to share resources, whether it's from accounting, whether it's from clerical assistance, office space, there is no profit. There's no one making profit on it. It's not taking any tax dollars. And one of the beauties in 1500 is that it was designated to be able to operate as a private entity. So I think it works very efficient. That's your question.
Do y'all write replacement cost policies?
Yes, sir, we do.
HO5s, HO3s?
No, sir, we have our own specific. As a matter of fact, in March of 2020, we went to all dwellings. Insurers had to pick one or two types of policies, either the ACV or actual cash value versus replacement costs. That was part of HB 444 that cleared up some language in the statute that gave us clear authority to write replacement cost policies. It is a wind and hail only policy, but it is a replacement cost wind and hail policy. So like the HO3s and 4s, because those cover other perils, we are strictly our own wind and hail, but we are a replacement cost policy. We have a replacement cost policy and an actual cash value policy, of which about 75% of our insurers have chosen the RCV policy.
Okay. So, and I guess my last statement that I'll make, I was 5 years old when Camille, and we were living at 138 Springfield Circle here in Jackson. And had a tornado warning. I remember to this day, because I remember Mama saying, "Don't open that front door." And what did I do is open the front door, and the glass door went boom right out in the yard. Had people, all my family's from Simpson County, trees down everywhere. And I'm going to go back to the statement that Mr. Tom made, that Camille was a wind-driven hurricane. And Katrina is a water driven. Now y'all are covering wind and hail policies. Was it water or was it wind?
We cover wind.
Was it water versus, or was it wind? It was both.
Yeah.
And there's a lot of challenges as to which came first.
Which was decided in the courts, I'm assuming.
Yes, sir. Fortunately, ours was settled. We were able to settle all of them outside of court, but there was challenges, yes.
And Camille had a storm surge of 24 feet.
I don't think it was that high.
Katrina had 27.
I don't know what Camille's was.
Camille had what?
But we've seen,
But one was a wind driven and one was a water
well, I think the wind speeds in Camille it was category 5. So the wind speeds were over 175 miles an hour. Katrina, when it hit, it was less than 125, the wind when it touched the Mississippi Gulf Coast. But we've seen Michael, we've seen Ida now, 2 narrow focus category 5, just like Camille was, hit in the last 3 years.
And the only people that can buy wind from the wind pool are the bottom 6 counties.
Correct.
Thank you.
Thank you.
Mr. Chairman, go
Yeah, I
ahead.
just want to ask one follow-up on that. Tom made the point that Katrina, of course, had the huge water surge. And back then, the flood insurance was not required. So now you will not write anyone unless they have an underlying flood insurance policy through the federal flood program. And I don't know if Tom wants to answer that or who would answer, but it sounds like that would make a huge difference now in another Katrina, in that you have a federal government paying up to, was it $250,000 per residence? What percentage of a Hurricane Katrina do you think that would fund in another loss? The fact that the federal program would now pay for flood, and we wouldn't have this argument over was it wind or was it flood?
Well, I mean, I think, and here's one of the operational issues. You know, there's always problems in the details. And while we have a requirement that you have flood if you're in an A or B zones as a condition for having wind, the problem is a good checks and balances to see if they currently have it and have maintained it. One of the problems with flood is a lot of it got purchased right after Katrina. But unfortunately, people start letting things go. And unfortunately, as the price of flood keeps increasing, and there are other changes on flood that are coming, we may see more and more people, if their mortgages will allow, or if they can get by without a mortgage, then they may not purchase some of that. We may or may not know that. I wish there was a better check and balance system of where I could guarantee it, but I'll tell you, if they've purchased a policy from us, and as a condition of purchasing, they should have flood, but at the time of loss, we discover that their flood insurance may have lapsed or had been canceled or whatever, we're still on the hook for the wind claim.
Senator Thompson, you're recognized.
Thank you. Thank you, Mr. Chairman. Thank you, members of the committee. I just have a few brief questions. All of my constituents are on the coast. I've got some constituent-minded questions, I guess you could say. What are the efforts right now to depopulate the wind pool, to get folks out of wind pool and into the voluntary market?
I think if you look at the chart, the slide that we have, improvements since Katrina, a lot of it has to do with the new marketplace that's coming in, the new carriers that are coming in. If they're in the wind pool, they need to be out shopping. I can't, as a local retail agent, that's easy for me to say. But what we've done from a depopulation standpoint, we've been very intentional about doing inspections and making sure people are insured to value. And we put in some cost estimators that standard insurance companies that utilize to make sure that people are purchasing the appropriate amount. Now, if we really think about this, every one of our wind pool customers most likely has a fire policy with either Safeco or State Farm or Farm Bureau. So they've got to have some balance in how they're buying their reinsurance. We've gone through a process inspecting every single exposure we've had. We started that when we had 44,000 units, and we've continued that through, and that just helps give us encouragement of the data. It also, as we went through, as Joe shared, the replacement cost policy versus the actual cash value, people were triggered to go shop. I mean, they had to look at their values. They had to look at what they were buying. So if somebody is in our pool, I would highly recommend they go see what's in the marketplace right now.
How often should they do that? Because I know from firsthand experience that a recent pre-Katrina construction, a 2004 construction that has been in wind pool since that time, since it was rebuilt in 2006, that can't get on the voluntary market, that hasn't been able to get a different wind policy. How often should these guys be looking to try to shop their policies, as you suggest?
I mean, it's a consumer decision. I shop mine every year. I mean, we have about 8 different companies in our shop that will write my house. It was constructed in the late 70s. So I want to see what's going on in the marketplace. They should go talk to their agent at least every year and say, hey, what else is out there? If they're with a direct writer that only has 1 or 2 companies. One of the neat things that's happened in this marketplace over the last couple of years is even some of the direct writers have surplus lines companies that they can write with in their shop. So they can get a competitive quote.
Is there anything being done at the state level that you're aware of to make or to encourage the voluntary market to take folks out of wind pool, to open up more policy options for those folks?
I mean, I think what the Department of Insurance is doing, they're doing a great job out recruiting viable carriers that can come in the state. I know there's a lot of carriers that may want to come in Mississippi that may be a Florida takeout that haven't earned the right to be here. And I mean, I think that's where our regulators do great work in bringing it to a free marketplace.
I think you mentioned earlier that part of the recent wind pool rate increase was to hedge off policy applicants from a carrier who was leaving.
Well, the
you expand on
marketplace
that?
has been tightening over the last couple of years. We've seen the Lloyd's of London products and some of the other surplus lines carriers exit and seeing capacity grow for the wind pool. So there really was a couple large factors there. We had not taken a rate increase in quite some time. The second factor there was we knew the market was going to continue to tighten from a capacity standpoint as well.
So basically, if we look at just what's happened in the short term since Katrina and in the very recent past, no matter what the best efforts of the department are, you're always going to need the wind pool. Is that fair?
Well, my constituents and I around the country, those 33 other states, we would like to find a way to go out of business. But unfortunately, there's probably not going to be the day that we're completely out of business. The residential property pool that I mentioned has dropped very low. We got less than 3,000 policies in it now, but there's still going to be some that are probably going to be in that uninsurable bucket. And some of that's going to be because of the risk itself. It's going to be because of geography itself. In some cases, it may even be the insured themselves, or they just can't find a market. But we're trying our best to encourage to not be competitive price-wise and to get out of the way and try to get people to mitigate and help them get their roofs mitigated so they can be more attractive and get out of the plan. We hope to get it as small as we can. But at some point, I'm afraid you're right. There's going to be a floor to it. I don't know where that is.
I want to one more comment on the rate increase that we took last year. And we worked with the Department of Insurance and worked through that. We only took a rate increase in the bottom 2 zones. And That's because those bottom two zones below I-10 showed the need for a rate increase. And if you go back to post-Katrina, those bottom two zones were somewhat subsidized in rate. The rate was spread differently. So that's why we saw that disparity, as well as we're seeing the exposure compress into those bottom two areas. But that was the least rate adequate areas that we had. So that's what also drove those two zones to take a rate increase.
Okay, I appreciate that. Thank you for
Yeah.
that. I do, just one, I want to make sure I understand our reinsurance levels here. Once we get above our self-insured retention, when we hit that first policy, is that on a per occurrence? Like if every time I have a Zeta, if I have 3 Zetas a year, I've got to go through that self-insured retention 3 times. Is that correct?
That's correct.
And I think that's a point that Scott, that Senator Delano has touched on. Happy birthday, by the way. That this idea that these storms are not just, it's not so much that they're increasing in size, they're becoming more catastrophic, but they're becoming more frequent. And that's what you're trying to insure against. You're trying to insure against what Southwest Louisiana went through last year with those 2 storms that hit in rapid succession. The risk here, in my mind, from, I want to say defunding, but from diverting some of the wind pool incomes, is that that first 25 million, we're on the hook for that every time a storm hits. And we get a year like Louisiana had last year, or like Florida had in 2004, you're going to be in that you're going to have to spend that first 25 million every time. Is that correct?
Yes, sir.
So that's a point I just want to make sure that we all understood. Thank you guys for your time. Thank you, Mr. Chairman.
Senator Board.
I'm going to ask, just stick with me here for a second. And as Senator Delano, there's lots of rumblings every year. And those of us who are a little bit north of that, sometimes issues come up and questions come up. And this is one that's come up. So just bear with me, and I'm going to give y'all the chance to directly answer this question. But if I'm looking correctly on your income chart, is except for the years 12, 13, and 20, where you paid out claims in hurricanes, you could have easily zeroed out the income from the non-admitted policy fee, and you still would have had a net profit for the year without even having to touch the 300 million in surplus. If I'm reading that correct, would that be a correct statement? If we took out years 12, 13, and 20?
If we don't have a storm, we're profitable, yes.
Okay, good. So here's my question for you though, and this is something that's circulated, is if we did away with the 3% non-admitted policy fee when this repeals in July 1, would y'all be able to operate on the income from your other income sources, such as the policy premium and investment incomes? Would we be able to do away with that? And if you can't, tell us why.
I'm gonna let Joe take that one. That's a great question. Where's our driver? I know our driver can answer that.
The answer is possibly, maybe. But no, when you talk about funds, and I do go back to that funding chart. I mean, we will not go broke. We have funds. Now, it is a matter of who will be paying. And yes, we are in good position. And I would agree with earlier statements. We shouldn't apologize for that. We are probably, I know of all the other pools around the country. I collaborate with them. I'm friends with most of them, and we're in one of the best positions of any pool around the country. We've depopulated in size. We have increased in reserves, and we're positioned as well as I think any other plan around the country for the next storm. Now, can we do that with less funds? Should we do that with less funds? I go back to say, we will take whatever funds are given and we will try to make them and put them to the best use possible, with or without them. But our goal is to provide insurance to the people on the coast who cannot get it, and to pay their claims when the storm comes, and we will pay it. And somewhere up that chart, And when you do, and all the way up until statewide policyholder surcharges, which is identified as an excess deficit, is still in the statutes. When everybody throughout the state pays, we will pay those funds and we will pay those claims. I don't need to avoid your question, but with them, we'll spend them as best we can. Without them, we're going to still issue policies.
Thank you.
So my perspective on that, thank you for that question. I think it goes back to some of the original wisdom in what happened after Katrina, and the admitted carriers toted the water for the loss. And the wisdom that came from that was for the surplus lines carriers to be able to have some skin in the game. I see it as a marketplace stability factor, so that the standard carriers that do want to come into Mississippi know that their assessment is hedged because the surplus lines carriers are paying every year. So I see it as a marketplace stability factor to continue to keep that in place.
It's a question asked. I wanted to ask y'all directly. Thank you.
Thank you.
Senator Hill, you're recognized.
I'm pushing it.
Green.
Okay.
There you go.
There it goes. If it's a series of good years, yeah, but if it's a series of bad years, no. And I guess going back to the fact that I'm one step above the lower three, and prior to Katrina, nobody in my area had ever been in a wind pool that I know of. But yet most people couldn't get a policy unless they had separate wind pool. So that, and I see that that's been drastically reduced back down to pre-Katrina levels, which is a good thing in my opinion. But my question is, you talked about how you shop every year because you want to see what the market's like for your own insurance. When we go to reinsure and you do that once a year, how are we shopping for reinsurance? How do we know that we're not paying too much for it? Is there any comparison of similar states as to how much reinsurance they get for a certain amount of money? How do we know that we're not paying too much for X amount?
That's a good question. How do we shop reinsurance? We shop reinsurance very similar to the way I shop my personal insurance. We look at all the carriers that are available, and we go and we ask them to price our product. Now, one of the things, the list of the things that have improved since Katrina have by and large been what we've heard from the reinsurance markets. Give us clean data, update your data every couple of years, give us secondary construction information, building codes, mitigation. So we've implemented with our reinsurance partners a lot of the things that were on that list. So we have built a long-standing relationship with them, and we look at if there's 80 different markets that we look at for different places on that map, we find the right combination of ones to buy. We hear tales when we meet with the markets, and our brokers do business in multiple other states. I think because Mississippi is very unique. You heard Mr. Quaka talk about that earlier. We're narrow. There's no spread of risk here. So Mississippi actually fits nicely in with certain carriers' spread of risk. And it changes every year. I mean, we've had partners that have been on there 15 years that don't make it because their pricing gets too high, or they can't play at a certain different place. We looked at one reinsurance map, and there's about 80 different carriers that play on this map. And we move them around till we feel like we get the best deal and get the best coverage.
Yeah, it was just my curiosity as to whether we've looked at the other Gulf states and looked at what they spend per dollar per reinsurance and see if ours is comparable. That would be a question that I had, if there'd been any comparison with the other Gulf states as to how much they pay for X amount of reinsurance versus how much Mississippi pays, because we're all kind of similarly situated on the Gulf of Mexico.
I was looking for my document. I was going to share with you what Louisiana, but Louisiana has purchased, they've kind of gone to a very similar tower than us for 2021. I think they're at 545. They're attaching at 35. and they've got some of these different layered approach. We as pools around the country, we do share and we talk and we meet. As I said, we have an organization called Property Insurance Plans Service Organization. I serve on that board and former chair of that board, and we do share. The thing is, you have to look at what you're protecting and the different geographical dynamics of each pool. None of us want to really get in bed with Florida. Florida is its own separate thing. But then at the same time, the makeup of our coast versus the makeup of a Orange Beach versus a Florida Panhandle
Yeah.
versus a Cape Hatteras versus Massachusetts, North Carolina, those types. So you have to look at it. So it is based on values, and it's also based on frequency. My counterparts in New York don't worry about frequency very much. I'll just share that with you. They aren't in the northern Gulf of Mexico. The one storm, that's not their concern. We're in a high frequency area. So we want to buy and protect things differently than perhaps my counterparts would in North Carolina or New York. But along the others, we do some comparative. And I think based upon what we get and the features of our policy, I think we're very competitive. And I think, matter of fact, we see some of them moving to similar purchases in some cases.
Well, my main concern is I want to do everything that I can or we can to try to drive rates down, because that's the best thing we can do for our constituents and for, you know, our state in general to attract more people, is for those rates to be lower. And, you know, we heard from our state economist the other day in the education meeting that $1 goes farther in Mississippi than it does anywhere else. So I think that ought to have some impact on what our reinsurance costs may be, you know, spread out from some of these other places. Because y'all know it takes way more to replace something in, you know, Massachusetts or anywhere else besides Mississippi. So when we shop, that ought to be a consideration, that $1 goes farther in Mississippi than it does anywhere else. I mean, that'd be one of my bargaining chips. But thank y'all so much.
Yep. Thank you, Senator Hill. Any other questions from the members? Okay, seeing none. On behalf of the committee, Scott, Joe, we want to appreciate, we know how busy both of you are. We appreciate your time, expertise, and testimony. Thank you.
Thank y'all so much.
Thank you.
Thank you.
Let's take a 2-minute stretch break while our final presenters for the day come to the podium.
Good comment, Senator Kirby. Good observation. Got a good job. Thank you, man. Appreciate it. Be safe. Trip home. Okay, be safe.
Oh, I decided to break my leg and my ankle. So stepping out the shower. I know somebody who works for you, Michael Lee. My son is dating one of his daughters. What's, they're pretty good looking. The one at Malota right now. Malota. At the police training. She's at police training right now. He said it's been there a while.
Yeah, he's vice chair. Good guy.
So do you know? You said it's done at that.
She probably is. I don't know if my son is. It's not, y'all did a great job. Thank you. Thank y'all for being here. Thank you for what you're doing.
If I am, I'll swing by. Okay.
Yes, sir. Nice meeting you. Mike McClendon, nice to meet you. It's too hard to go anywhere. I'll just piss my pants.
I am,
Ethiopian restaurant in Jackson.
where?
We saw it somewhere. Saw headlines.
On TV or passing by?
No, we didn't see it. We saw it in writing.
Wow. We'll have to Google it.
Thank you, Chairman Michelle and Chairman Zuber, members of the committee. My name's Stephen Clay. I'm here today representing the Mississippi Speech Language Hearing Association. Just wanting to share with you the need for some health insurance coverage of hearing aids for our children up to 21. In fact, legislation was introduced last session by Senator Chisholm, Senator Boyd, and Senator Sarita Simmons, along with Representative Steve Massengill, that would have provided that coverage, the same as Medicaid covers for our children up to 21. We've got an audiologist, Courtney Turner, an SLP, Rachel Powell, here that they're going to share about that need, and along with Senator Chisholm. So further ado, Rachel Powell.
Thank you, Stephen. Thank you, Senator Michelle, Chairman Michelle, and Chairman Zuber for having us today. I am a speech language pathologist and legislative chair for the Mississippi Speech Language Hearing Association. I work in Brookhaven School District, just south, about 60 miles on I-55. So I feel like my area of expertise is in regards to reading and literacy. So I practice as a speech therapist, but I'm also the literacy lead teacher for the school district in Brookhaven. And I can speak to how many children I've had with hearing impairments over the years, and almost 20-year career span, and the impact of their outcomes educationally, academically, and ultimately vocationally when it comes to them graduating from high school and getting a diploma and entering the workforce. At this time, I'll turn over to my colleague, Courtney.
Thank you. Good afternoon. I'm Dr. Courtney Turner. I'm a pediatric audiologist from the University of Southern Mississippi. I am also a board member of the Mississippi Speech Language Hearing Association, and I serve on the advisory committee for the Mississippi Early Hearing Detection and Intervention Program. I work specifically with children birth to age 5 who are at risk or have been diagnosed with hearing loss. So I work with this population firsthand. And I can say that Mississippi does an excellent job of screening all newborns for hearing loss before they leave the hospital. And they do a great job of identifying those babies early. However, private insurance does not cover these medically necessary hearing devices for the children who need them. Currently, Mississippi Medicaid reimburses hearing aids for children birth to age 21 at a rate of $1,600 per aid. Also, 25 states, including Louisiana, Texas, Arkansas, Tennessee, and Georgia, have recognized the necessity of these devices for child development and have passed legislation to further ensure private insurance coverage of hearing aids for children. I'm here to present data in support of similar legislation here in Mississippi. I would like to jump straight into the numbers because I know that's the burning question on everyone's mind. What is this going to cost private insurance? The incidence of childhood hearing loss is approximately 1.7 per every 1,000 live births. Yes, it's 1.7 per 1,000 live births. So that's about 0.17%. That is a very low incidence. That rate comes from CDC reporting, and it matches with our state early hearing detection and intervention reporting. If we take that 0.17% incidence rate and apply it to the most recently published Mississippi Vital Statistics report, which indicated 36,634 live births in 2019, that would suggest approximately 62 infants and young children diagnosed with hearing loss that year. Now, taking into consideration the potential for loss to follow up, so there could be more children with hearing loss that we did not identify, and then the potential for development of hearing loss later in childhood. Let's use a very, very generous estimate of 100 children per year diagnosed with hearing loss. The two major pediatric audiology clinics in Mississippi, University of Mississippi Medical Center and the University of Southern Mississippi, analyzed data on pediatric hearing aid fittings from the past year, and they determined that only 10% of the pediatric patients they saw for hearing aid fittings each month were not insured by Medicaid. So if we take that very generous estimate of 100 children per year being diagnosed with hearing loss and needing hearing aids, if only 10% of those are not covered by Medicaid, we are asking private insurance to cover a maximum of 10 children per year. Now, assuming those children have hearing loss in both ears and need 2 hearing aids, which they may not all, if private insurance reimbursed at least at the Medicaid rate of $1,600 per hearing aid, the maximum potential cost would be $32,000 per year. $32,000. The average lifespan of a hearing aid is about 5 years, so it would need to be replaced about every 5 years. So if insurance would cover a pair of hearing aids every 5 years for a child from birth to age 21, that's only $16,000 per child over that span of birth to 21 years of age. These are very low numbers we're talking about. But let me tell you about the impact on these children and the long-term fiscal impact that this small investment will have. As adults, most of us are familiar with the impact of short-term hearing loss due to maybe congestion or short-term loud noise exposure. Or we may have a loved one or have personal experience with losing some hearing as we have aged. That is nothing compared to the lifelong impact that hearing loss has on children. Our ears are directly connected to our brains. Before we're even born, our brains are ready to receive information through our ears. When an infant is born without normal hearing, their brain has already been deprived important sensory information. Hearing loss in infancy and early childhood has been described as a neurological emergency, and it is. It's not just an ear problem, it's a brain problem. When it's left untreated, an entire cascade of developmental issues begin to occur, and the longer the delay in getting treatment, the poorer the developmental outcomes. The Joint Committee on Infant Hearing actually recommends that hearing devices be fit by 6 months of age. Any later than that, you see these developmental gaps that begin to get more and more difficult to close. That is how critical this period of brain development is. So imagine being a brand new parent, and keep in mind that 95% of infants born with hearing loss are born to parents with normal hearing. Your baby fails her newborn hearing screening. You think nothing of it because hearing loss doesn't run in your family. You go to the audiologist for a full hearing evaluation and receive the news that your baby has severe hearing loss and will not be able to develop spoken language, will not be able to communicate with you or your family, your extended family, unless they are fit with hearing aids immediately. And although you work full-time, you and your husband, and you pay into insurance, your insurance does not cover a penny of the $4,000 to $6,000 that those hearing aids are going to cost you. And they need that money immediately because the longer they wait, the poorer the outcomes are for that child. So you can imagine how that conversation goes. Whenever the cost hinders the family and the hearing loss goes untreated, or worse, when the family seeks a treatment that might be cheaper but is not appropriate, such as an over-the-counter device or an amplifier, we see very, very poor outcomes because the brain's not receiving adequate auditory stimulation. That part of the brain actually starts to rewire. It's a use it or lose it type of situation. We also know that we speak the way that we hear. If a child doesn't hear speech clearly, they're not going to learn to speak clearly, which is going to lead to speech and language delays. If we can't hear all of the speech sounds clearly, we're not going to be able to learn to associate letters and sound combinations, which is a key foundation for literacy. Literacy is the key to academic achievement. Without appropriate management, it's shown that children, even with just mild to moderate hearing loss, achieve 1 to 4 grade levels below their peers. Those with severe to profound hearing loss typically will not achieve higher than 3rd or 4th grade level skills. Children with untreated hearing loss have difficulty with social interactions. They can't communicate effectively with their peers, and they're more likely to have social, emotional, and behavioral difficulties. All of these things together lead to limited vocational choices. So you can see the potential economic impact of untreated hearing loss due to the increased need for special education services, as well as into adulthood due to the impact of lost wages and work productivity. In summary, I'm asking the Insurance Committee to consider following the lead of our surrounding states. Consider this legislation to invest $16,000 to ensure that a child has the access to communication, educational, and vocational opportunities that will save the state hundreds of thousands of dollars in the long term. Thank you.
Thank you, Courtney.
You have those the calculations you could present us, or prior to the session, run through the numbers of the estimated amount of children and the cost and.
How do we calculate those numbers? Is that what you're asking?
Well, the numbers that you just
Do you have
mentioned,
this?
I wasn't able to write them off. I didn't get one of those.
Yeah. It's on
Is
the
it in our
back.
packet? I'm sorry. Okay, thank you so much.
And Mr. Chairman, if I may, I have a couple of questions. Walter.
Thank you.
Ladies, thank you for coming up here and testifying today. We appreciate your time. And I have an interest in this subject matter. I think you mentioned that Medicaid covers up to the age of 21.
Yes.
Is that correct?
Yes, sir.
And we have 25 other states that have this mandated coverage.
Yes, sir.
Up to what age do these other states cover? Is it 21 or is it less?
It
in some
varies.
cases?
Some are 18, some are 21. It varies.
If you look on your handout, Louisiana is to 18, Kentucky's 18, Tennessee's 18, and Texas is 18. The logic behind up to age 21, because that covers special education. Sorry, up to age 21 covers special education services in the school system. So through IDEA, we're providing services to those students all the way through age 21.
Are there any states that provide this coverage less than the age of 18, up, like say maybe 15 or 16? Or is,
We
I
can,
know there are some that cover higher. Let's see. North
higher than
Carolina-
21?
No, higher than 18. See, North Carolina goes up to 21.
Rhode Island.
Rhode Island is 19.
We're not aware of any that cover under 18, but we can certainly check on that. At this time, I'd like to turn over to Senator Chisholm for her personal experience with this.
Thank you, Mr. Chairman. I have a personal interest in this bill. Thanks to Senator Boyd, she helped me to come up with this bill, and we dropped it a year ago. And we also had it back on the floor this year, and it did not come out of committee. But my personal interest in this bill, I grew up with a deaf uncle. And for anybody who has not ever been around deaf people, I know it's hard to understand, but I saw the little things. I saw the things like when somebody rings your doorbell, you hear that doorbell, they don't. And a lot of them don't have the opportunity to have the lights hooked up to the doorbell. Some of them do. If their light goes off, they know somebody's ringing the doorbell in the middle of the night. If a fire alarm goes off, they don't hear it. They have to have someone in the house who can hear. My uncle, he grew up to marry a lady that was also a deaf mute. They didn't have anybody, they never had children. They didn't have anybody in the house to help them. So in the middle of the night, if the tornado alarms are going off, they don't hear them. They have to they depend on somebody to come and get into their house and let them know. They don't have the opportunities in life that we have, even in the workforce, because they can't do a lot of jobs that we can do. So as children, if we can help these children so that they don't grow up to be hearing impaired, if we can help them at an early age, $32,000, that's no money at all to help these children and put them into our workforce when they do grow up, give them the opportunity to have a normal life like we do. They can't just pull through a drive-in and drive through and ask for a hamburger, order fries and a drink like we can. They have to actually go inside write a note or whatever they have to do to communicate with the people. So it's just a personal thing with me. I'll be glad to answer any questions if anybody has any.
I have one follow-up. I'm trying to educate myself on this. I assume we're talking about both the private sector and the state health insurance plan, both? Okay.
Yes, there would be that ultimate goal for both the private and the state health plan to cover this. But right now, as a state employee, if I had a hearing impaired child, I would not have that coverage.
So it's only Medicaid that's providing coverage now.
Correct. Which, think about our Mississippi teachers. And there's been so much conversation around Mississippi teachers and their salary levels. And we know teachers who have children diagnosed with hearing impairment, and they're coming out of pocket for $4,000 to $6,000 for hearing amplification. That's a necessary skill for them. And really, it's such a low incidence disability, meaning that there's very, very few children, you can see from the numbers, diagnosed each year with hearing loss. And of those that have hearing loss, not all of them are necessarily needing hearing aid amplification. They may not all need hearing aid amplification in both ears. In my 20-year career span, I've probably had less than 10 students on my caseload as a school speech language pathologist with hearing impairment. And the majority of those students are Medicaid eligible. It's just strictly our basically working class families that don't have this coverage.
And again, just as a matter of trying to get all of the information, are there any states that provide maybe a separate policy where the premium is a little bit higher to provide this type of coverage?
Not that we're aware of. We're getting our information primarily from our National Speech Language Hearing Association, but we can definitely follow up about that.
Please do. Thank you.
And just to follow up, Mr. Chairman, the reason we chose 21 was because it mirrors the Division of Medicaid and how they cover. In addition, and talking with Cindy, and she pointed out, Cindy Bradshaw with DFA, pointed out that hearing aids are exclusively prohibited in statute. So that's one of the reasons why the state employees couldn't cover it unless y'all change the statute.
Thank you, Stephen.
Other questions? Stephen, thank y'all so much for your
Well,
presentation.
Thank you. And we really appreciate the opportunity to share that with y'all.
Okay, we stand recessed until 9 a.m. tomorrow.